Well, welcome everyone. This is our podcast series, and we're very fortunate to have Bruce Croxon with us today. So, welcome, Bruce.
Hey, good to be here, Dave.
Yeah, we've done some of these with you in the past, and I thought we'd sort of just change it up a bit with some different questions and that. And really, what we've never done, Bruce, is gone back to sort of the beginning of, I guess you'd call your career, isn't it? Something that you might have started in high school, I think it was, Lava Life.
Yeah,
And
didn't
so here, I want to start here. You built Lava Life pre-smartphone, definitely. It was in the 80s
yeah,
and scaled it. What's different or not about scaling companies today? Like, how have things changed since your early foray? And explain to everybody what Lava Life even was.
sure. Yeah, so listen, I was in my mid 20s, so it was a little post high school, but and I'd already made the decision that, being an entrepreneur and growing my own thing is what I really wanted to do. So, double click for anyone listening to this that are entrepreneurs or think they want to be entrepreneurs, or your kids want to be entrepreneurs. I always say that the biggest decision you make is just deciding to do it, because if you hang around the hoop long enough, you'll catch a ball. And sure enough, I was in the game, came across this technology called interactive voice response at the time, which we now all know the killer app for that technology was voicemail. So push one on your touchtone phone to get this response from a computer. And we figured out early, this was even before voicemail caught on, that the most popular application for that technology, except aside from voicemail, as it turns out, could be using the technology to put people together, quote unquote, online, which was online at the time, over the phone lines, to get together for dating. And so we launched a brand called Telepersonals. Uh, you know, Basically a predecessor to how you think about the internet today. A lot of people setting up voice mailboxes, sending messages back and forth. We charge people to pick up the messages, but while you're online, you can also exchange messages real time with other people that were online. So it's really the first online version of chat in the world. And I would argue that it was the first social network in the world. So that put us in a really good position. Long story short, that when the internet became mainstream and commercialized in the mid 90s, we were in a very good position because we were already connecting people just using a different technology. So we bought a company called Web Personals out of the States for, I think it was like for $250,000, rebranded both the services to Lava Life. And now you had a choice. You could either, use your telephone, use your internet connection, but the objective was still the same. I want to get a date for Friday night, or I want to meet the love of my life, and everything else in between. And we slowly just got more and more organized around that message as the technology evolved. Now, yeah, you opened the podcast by asking me, what the difference is in scaling a tech business today versus back then. And it's a really good question, because we've seen, obviously, was it 27, so I'm 64, so 37, so that's 35 years of technology evolution. And back when we started, you walked into our tech room with the phone lines running into the back of computer systems, and then even with the computer systems that were running the internet, it was a massive investment in hardware and software. So, the technology in and of itself, and the code we wrote, and the money we spent on building the tech was in and of itself a barrier to entry. So we were, I've been known as a technology guy ever since. Side story, that the engineers used to just laugh at me when I'd come into the computer room, wonder what the hell I was doing there, because I never really did understand how the code worked or anything like that. I just got pretty good at understanding what it could do, from creating products that people might want to buy. But back then, the point being that the technology was big, it was expensive, it was cumbersome, and that gave us an opportunity to scale and make mistakes and not have to go at the speed of light because people didn't really understand what it was that we were doing. It was a big black box, and if they did figure it out, it took a lot of capital. Now fast forward to today, and then we can fill in the blanks in between. But you're hearing about a couple of kids in their basement with the help of artificial intelligence scaling technology companies from 0 to 5, 6, 7 million in months, not years, because the AI is doing the coding for you. It's not a mystery how the code works anymore. Computer engineers are not are people are companies are chopping their conventional computer engineers because the AI is taking over. So I would, with evidence, put forward to you that the technology itself is no longer a barrier to entry. So what is a barrier to entry if you're going to start up a technology company or maintain your lead or grow value? What is marketing. So when you get a sniff of something that works, you got to move. Like you've got to acquire customers. You got to keep the customers happy. You've got to acquire your customers for less than what they're ultimately worth to you. So the whole equation has shifted from, you got to move fast, from the technology itself keeping your competitors away, so you got time, you can sort of at your leisure grow and scale, versus now it's like it's easier, but that's a good thing and a bad thing, right? Because it's great because you can get going and off you go, but you're always looking over your shoulder because people are disrupting you left, right, and center. So those are the two sort of endpoints answers to your question. And in between, it was like, we slowly saw the cost of software and hardware come out of the system. The systems got smaller. The voice business went from having to set up a local office to voice over IP, which is voice sent over the internet. So we were able to centralize things. But by and large, it really was, as I look back over that pendulum, it really was the major difference was like the investment that you had to make to protect your market, but also gave you the comfort of keeping competitors away, versus today that it's like, you got to have your sneakers on from day one and be ready to really move fast when you get something that resembles product market fit.
I bet. So, just finishing up with Lava Life, you obviously sold it, I guess. To who'd you sell it to, and how in
Yeah.
those days, and when did you sell it, and how in those days did you come up with the valuation, and how does that compare to sort of valuations now in today's environment?
Well, it's interesting, like uh, for those of you that have followed the tech industry, particularly, I mean, I guess our latest example, I won't take everyone back to the 2000.com bubble, but, 2021 in our industry, got a little crazy. And that happens when you get a lot of money on the sidelines. Times are good. The S&P, the conventional stock market, is rocking and rolling. Everyone thinks they're so smart, and as a result, multiples get bid up on a multiple of revenue basis, not necessarily paying any attention to whether and how and when that's going to turn into profit. And if you look at today, that has been massively corrected, where the premium is back on what you guys, I'm sure, talk about all the time, conventional earnings multiples that you can count on, to make for a good investment, dependability. So that's how the tech industry swings back and forth. When I sold Lava in 2004, I sold it to a US public company by the name of MemberWorks. They were really behind in terms of online products and services. They had a lot of conventional through the mail clubs and offers and this kind of thing. And they really wanted to expand their offering and grab a bunch of consumers that were more progressive and forward thinking. And they paid us, it was a public deal, they paid us 182 million Canadian in 2004. So it was a very notable Canadian exit. And I believe our EBITDA at that time, the year we sold it, was its peak, was about 16 million bucks on 100 or so million of sales. So it was, it was a healthy multiple of EBITDA. And that multiple of EBITDA they paid would not look out of place today, as we've reverted back to more conventional ways of valuing companies, right? So I think, as I say, 16 million bucks at 182 million dollars Canadian, and having a conversation with a shop like McNichol, you'd be nodding your heads. Oh, that kind of makes sense, right? And 2004 was, like 19, 20 years ago, right? So, some tried and true principles hold up over time, and we revert back to the mean. Aside from when you look back, there's some brief periods of absolute craziness where people sort of lose their perspective and think that something's changed when at the end of the day, it really hasn't.
Okay, well, that sounds like those multiples haven't really changed too much from just doing it in the back of my head here. So, congrats on that. That was a long time ago.
It was,
Now, sort
yeah.
of bring us up to date as to, you launched round 13. Remind everybody when
Yeah.
to fill Canada's growth stage funding gap,
Yeah. Yeah.
and how's it going? How's it
Yeah.
doing?
So I, fresh off, I stayed on for 2.5 years after the sale in 2004 as CEO of Lava Life. Um, Longest 2.5 years of my life. Again, I guess it's not an uncommon story as entrepreneurs sell their company and then report into a different board. And, they treated me very well, but, it just wasn't the same. So, but I said I'd stick around, and I did. So after that, I started, okay, listen, I like I still love the idea of taking small businesses and growing them to medium size, but I didn't really want to go back in and do my own startup again. I'd been 15 years focused on the vertical of online dating. That was a lifetime for an entrepreneur. So I started doing angel investing and didn't do a particularly good job of it. I was cutting my teeth and learning as I went, but I enjoyed it enough and had a few early enough wins that I said, let's look at doing this a little bit more formally. So flash forward to 2012, actually, the phone rang, and it was Dragon's Den calling from CBC. They knew about the exit. They'd approached me at the time. I'd said no, I didn't really want to be on TV. I didn't have a reason to go on TV. And but launching round 13 in 2012, 2013 finally gave me a reason to say yes to Dragon's Den. And so I did. I said, okay, I'll do that. And when I went on the show, I'd never seen it before I went on, and, quite candidly, have never watched it since. Um, but I'd underestimated just, the reach of that show and how many Canadians tuned into it. And so the marketing benefit of launching an investment firm, talking to the country's entrepreneurs to say, look, if you're thinking about if you're thinking about looking for money to scale a tech company, round 13 is the place to be. Was very it was very effective beyond my sort of wildest dreams. So we got a lot of inbounds on people looking to get backed. We were a combination of operators like myself and some more seasoned investment professionals that have been there, done that in terms of investing venture capital. John Eckert, my partner, was one of the first VCs in the country. We built a really good team around us, and our first fund close was 96. It took okay. So here's a little told story. I don't love telling it because I went into this fundraising thing. I'm a seasoned entrepreneur. I've grown. I exited my own company at 180 million bucks. I've got John Eckert beside me, who's was the top quartile VC returns on his last fund, McLean Watson. How tough can this fundraising thing be? So out we go, and it took I couldn't believe it. Like, people looked at us as a first time fund, and maybe it's a comment on Canada. I don't know, but it took us a long time to raise that first $96 million. But we had a couple of good early wins. 2014, no, actually probably closer to 2017, 2018. Time went really fast, but we had a good couple of early wins, and then the money started to flow. So if you look at round 13 today, we managed just in and around $1 billion across 4 different strategies. The latest one for John and I, where we spend most of our time, is in the blockchain crypto space, and the standard venture capital later stage. We moved much later on most of the round 13 portfolio. And we recently acquired a debt fund as well, where we're providing high yield debt to funds that, or to companies that want to sit, but in between what the bank will do and might not qualify for senior, or they need additional capital, but aren't interested in the more expensive equity. So we've kind of and we've stayed, to your original question, we've stayed true to our roots in that, of our 40 odd investments, 39 of them are domiciled in Canada with a global audience. So we've always felt that, Canada, there's more than enough to be done here. We can hold our own with anyone in the world. That's brought some challenges with it, which I think we'll talk about a little bit later. But it's still a great place to grow a small business. Where the country runs into challenges is actually at the stage that we continue to try and fill, which is when you get something that works. Often you look around the table and there isn't enough capital in the country to keep the countries home. So we end up selling a lot of them maybe before they should be sold in an ideal world.
That's really interesting. I'm just going to go back to one comment you said at the beginning about selling basically what turned into a dating service, and dating services are quite common now. 2 of my 3 kids used Hinge to meet their partner, and I think Hinge has a slogan: the one app you'll be happy to delete once you've used it, something like that. I think it's brilliant because you want to meet that one person, and in my 2 kids' case, they have met that one person. They've both been married now, so it was all great. And when our daughter got married, one of her young friends said to me, "Oh, Dave, this is going to cost you a pretty penny for the wedding." I'm like, "Well, that's life." He says, "What you should do, you should contact Hinge and tell them that they should advertise or use their platform to help you pay for the wedding." So I stupidly actually went onto Google and looked up Hinge and saw that there was like about 10 other companies that go into it. You'd know better than I would. And I thought, I'm not going to do this. That would have been, I probably would have wasted a couple of days of my time trying to do something for that.
No, but listen, it was
good idea, I guess.
It's the most popular way, I think, still for people to meet. I often liken it to Maslow's hierarchy of needs, right? If you're going to start a business, and it's funny, on Dragon's Den, the years I spent there was so many pitches, like 225 a season. And so many of them would come on and spend the first 3/4 of the time trying to convince you that there was a human need for the product that they were presenting. And if they got you there, then it's, oh, here's my idea. But, at least, with dating, it's right behind, a roof over your head and food in your stomach as the next thing you're looking for in life, in terms of your basic human needs. So that makes the marketing a lot easier. You're not trying to convince a consumer base that, that you have a product that you otherwise wouldn't be interested in. You're definitely interested. Most people, unless you're a hermit, right, you want to be hanging out with somebody. So we were in the right place at the right time for a replacement way to do it, rather than bars or the church or the school, like whatever. This was something different, right? Efficient too,
Yeah. No, I'm a big believer. Okay. Going back to the fundraising, your first fund. Yeah, I totally sympathize with you. It is really difficult out there, even in today's environment, but definitely as a brand new company. getting people to believe that and even though you'd proven it already, that you'd done it in the past, people, Canadians especially, really want to wait things out, and they think watching for 3 to 5 years is really going to make their decision a
Yep.
better one.
Yep.
Yeah, it's actually, I'll
Well,
tell
it's
a
funny.
side story.
Yeah,
Sorry, go ahead.
go. No, well, I was just going to say, like the institutions, it was like almost a non-starter. So we pivoted and went and saw fellow entrepreneurs, high net worths, family offices, which made for a lot of shoe leather, right? Because there were smaller checks and more meetings. But it was really the entrepreneurial community in Canada that got us going and provided
Yeah.
the bulk of that 96 million. Sorry, I cut
If
you off.
you're Actually, I'll go back to my story in a
Yeah.
moment, but if you're to do it all over again with hindsight being perfect, would you maybe start in the States and try it there, or would you be too unknown there, or how would you do things different if you were to do it
Well,
over?
I don't want to live in the States, right? So
Yeah,
I've been accused of being overly patriotic. I actually think we live in the best country in the world. And when a lot of our smart and wealthy people left, my attitude was not one of envy, but it was okay. They just, there's a little bigger void for me to go in and fill, less competition. So I don't know. I really like it here. I like Canadians' persona and personalities, aside from the conservative, uber conservative point that you just rightly brought up. I like hanging out with us more. So no, I'd like to think that we'll find a way. So if I had to do it different, um, maybe I would have raised $40 million, closed it off, and laid down a track record quicker.
right,
Maybe I would have done 2 seasons of Dragon's Den instead of 3 because it was so distracting and focus is choice. So could I have made some bets with my own capital sooner, laid that down as a track record? Because our early bets that we made before the fund was closed all turned out to be pretty good bets. I was right. Like I was getting better at it, and I attracted a team what that made up for the things that I wasn't the best at, like structure and like how to best protect the downsides on paper when you're papering a deal. I'm an operator. Like I only see like this is going to be great. I'm optimistic. Let's go. But and John's sort of saying, "Oh, not so fast." Did you think of this and that? Well, no, I didn't. Okay, so that's how you sort of put a team together, right?
for sure. Yeah, so no, just going back to fundraising, our business, as you probably understand, isn't really a fundraising business. It's more of a word of mouth,
Mm-hmm.
organic growth, one family at a time.
Yeah.
And I started it in 2001 with a bunch of loyal clients and friends who followed me from my previous firm,
Mm-hmm.
and have grown it quite a bit since then. We've been fortunate in the last almost 10 years of changing our model from organic only to working with planners and accountants across the country. And especially the planners, they really have a need to move away from mutual funds into properly managed portfolios. And if they don't do it, these 20-year relationships that they've built up with families that have started with nothing and now have seven-figure accounts with them, they get snapped away in one day by the bank. The bank will come
Mm-hmm.
in and tell them everything that they need to hear, and loyalty disappears quickly in this business.
Yeah.
So that's the trade-off now. We still grow organically. We try our best to keep on top of our clients, keep them educated as to what we're doing.
Mm-hmm.
These type of podcasts and webinars that we do
Mm-hmm.
are
Mm-hmm.
just hopefully assisting in that. But getting to my long statement, back in 2008, talk about fundraising. We're in the what turned out to be the middle of the credit crisis. I thought was the very early stages, and I thought it was going to go on for several years. um, we had a couple family offices and a large institution that I dealt with. So you got to speak to this one fund that's starting up. And we met with Georgian partners. You know
Oh, yeah.
Georgian very well in
Sure.
2008. And Justin Lafayette came through the door, and I introduced, said hi. And the first 30 seconds, I said, I'll hear your pitch, but I'm not buying
Mm-hmm.
because we can't make any decisions right now. I was
Yeah.
like,
Yep.
ultra scared about what was in front
Yeah,
of me.
sure.
And after 20 minutes listening to their story, I interrupted them again and said, "Yeah, I'm changing my opinion. We will invest with you." And we had to dig in deep. That was a $10 million order. That was our largest one in the early stages of what we did in alternatives, and it
Yep.
worked out well with Shopify and
Yeah,
Turnitin
yeah.
and so forth. They've had their challenges of late, as
Yep.
every private equity
Yep.
firm has
Yep.
had.
Yep.
And
Yep.
maybe let's roll into that. What has gone on to make private equity so challenged right now, and how has it affected your side on the late stage venture capital?
Well, it's always been like everything, like your business as well. I mean, it's called a cycle for a reason, right? I mean, cycles do happen where, valuations are like how I referenced earlier in the pod. It was like in 2021, some of these technology companies, like the average on the Bessemer Cloud Index was up to 18 times revenue as a multiple, with again with not a ton of regard for EBITDA, right? So when you look at an environment like that, where and people are getting in and out on the same cycle, right? So it get what happens in Canada is that when institutions see those kind of returns, that's when they tend to pile into the market. And a lot of funds got launched at the very top of the market. And guess what? You make bets at 16, 17, 18 times while you're seeing blood in the streets now. Are those companies aren't worth what they were paid for. And because you know a lot investors were willing to overlook fundamentals, I always sort of, and listen, I'm not preaching like we were immune. Like, I've got one investment in particular where Tiger Global. I don't remember those guys that entered the market, and they didn't even bother doing diligence. They just said, "Look, we've got $1 billion to put out there. We're just going to do it and go with the old venture capital. Like, something's got to happen 1 out of 10 times to pay back the fund." So they came into one of our investments, and we were right in the middle of the euphoria and the hype, and rather than standing pat, and I can't even remember if selling to them our shares at the time was an option. Probably not. But we followed on, right? So I'm sitting there with this investment in this company that's like up around 22 times revenue, and they haven't grown back into their valuation yet. So that's that's what happens during cycles. It's rare to find the backer that in the midst of the chaos, right? And like what happened to you in 2008, in the midst of the shit, we're going in anyway, right? And as it turned out, that was a great contrarian decision. That is the exception rather than the rule. So the reason that it's been such a tough period lately is we're hungover from the time when the valuations went crazy. People didn't have the discipline not to follow on, and as you sit in the market today, the multiples, that same cloud index is down at 4 to 5 times. So a lot of the venture capitalists are sitting with portfolios that where they invested up here, and now they're sitting at multiples that are down here. So that's a lot of growth that you have to make up for organically to adjust for that multiple adjustment, right? So that's where we're at. And once the market catches a cold, it sort of turns into a fever because everyone sits on their hand and is kind of afraid to move. And as a result, the early stage, the entrepreneurs are feeling poorer. The early stage guys don't get funded as quickly. There's all kinds of uncertainty. And I know we're going to talk about this a little bit with the tariffs and the economic climate. This isn't the best environment for risk taking because people don't know what the next 18 months are going to look like, right? So they're sitting on their hands.
Yeah, actually, let's just jump right into that on tariffs.
Sure.
And yeah, as I said earlier, I don't want to get into politics, but is a real thing. Tariffs have always existed, interprovincial, intercountry. Just maybe just high level. How is that affecting your industry? Are they adjusting, or do they have to still wait and see, or
Yeah.
what's are the next steps?
So listen, I mean, I'll make a broad statement and say that technology by and large has probably been less affected than some more conventional businesses, just because it's harder to tariff software, and where does it originate from? It's not really in keeping with the thesis of trying to bring manufacturing home. Although say that to Apple, that they'd be an exception to that. But yeah, I mean, the main way it's impacted us is we have a software investment where the auto industry is our client, and events around the auto industry is our client, and there's no events around the auto industry because those guys don't know which way is up right now. Like that industry's been thrown into turmoil at the OEM level, so they're out. That particular company that provided software for those events, has we've had to put that in mothballs. Thankfully, they have a division that's doing very well in a different segment, but that proved to be challenging. We have a conventional online uh, consumer goods business that is not unaffected by the tariffs. But by and large, the main impact is the one that's impacting everybody, which is we don't. It's tough to make plans when you don't know, what Trump's going to do a week Saturday, and how permanent some of these moves are going to be. So that's why fundraising is ground to a halt. That's why high net worths are not cutting checks into early stage companies. That's why companies that we would normally sell to are not buying, which is, that's how we get out of some of these investments. And that's why the IPO market for technology has dried right up. There isn't any. So it all stems from that. I predict that when things settle down, I think what's going to happen, and I had the benefit of sitting in your chair as you're interviewing me. I got to do that twice in the last 8 months with Stephen Harper. And, the last one was 4 or 5 weeks ago. And he just said, look, I think we're witnessing him sowing his own demise right now. I think the inflation's going to rise. I think he's going to realize that, tariffs aren't the answer. And then you're going to see some adjustments where we'll hopefully get back to something resembling normal. And that'll inject some confidence back into people that would normally be, for example, buying up companies or merging companies together. And, the exit market will come back, hopefully, and then we'll be off on another cycle.
Yeah, no, it really is all about interest rates at the end of the day and how they're impacting the markets and that. People really just didn't recognize through the 80s, 90s, for 40 years from the 1981, we had declining interest rates. And at any moment for that 40 years, you didn't know what was going to happen the next year, but the trend was definitely down. That stopped at COVID. That bottomed out at COVID, and they've been rising ever since. We've been
Mm,
calling it ever since 2009 to be out of bonds. We haven't touched bonds unless a client has to have that sort of cash flow. We've been rolling short-term bonds for them and specialized bonds. But yeah, we're in a rising rate environment right now. Inflation is key. Here's Trump trying to force the Fed to drop
lower
rates,
rates. Yeah.
and yeah, that's just more inflation. More quantitative easing is going to be more inflation. And we actually have one analyst who we've been working with for a few years now since COVID, who's calling for interest rates to round trip all the way up to their all-time highs of 1981 of
Really?
14% for the long bond in the US, and not
Wow.
over the next 40 or 30 years, within the next 10 years. So he's talking
Yeah.
about more rapid inflation. That's one person, right? And we
Yep.
don't make our decisions based on one person's opinion.
Yep. Yep.
But we do look at outliers. That's what helps
Well, and
us
then
at
and then
these
you got to
turning
ask
points.
yourself. I know there's a correlation, but when you look at corporate bonds, do you do you make a do you look at those separately with a separate analytical lens than the bond market that is directly impacted by by how much the U.S. has to borrow,
That's right, or just government
or governments
currencies
in
and
general,
bonds at
right?
the same
Yeah,
time. They're just we've always been saying for years they're out of control, but now they're truly out of control,
yeah, yeah.
and making up new handles and ways to confuse their audience. But
But that turns you
who
off
knows?
corporate bonds as well, does it? Like just by
Yeah,
because it's
yeah.
all
We'd rather not. What we're actually just about to launch a debt fund. So I'd
okay.
love to talk to you about
Yeah,
your high yield
yeah,
people there. We don't want to do any debt for real estate. We already have a real estate fund, so that's separate,
yeah,
and that's got like a 15-year track record. This will
yeah.
be a new debt fund. We've been planning it for 8 years now. Believe that. Like,
Wow.
are we ever slow? And we just haven't found the right time to launch it. We've also had problems with the legal community in Canada. In my opinion, is very difficult to work with. They give you a quote, and 6 months later, when you're ready to launch, that number is magically changed. And sort of like
Hmm.
building a house, we've all experienced that with home building. If once again, if I was doing it in the U.S., you get a U.S. quote for legals, it might vary by 10%, and you would be notified along the way. So that's been a real challenge launching this debt fund, which is really just going to be a spin-off or an adjunct to what we're already doing in alternatives. But we'll get it right.
Yeah,
We're life is long, thankfully,
yeah.
so we'll get
Hey, I
this
take a
right.
long view.
Yeah, and we want to make decent returns in the fixed income, if you will, environment. None of this is fixed. It's mostly private, and then we will be doing some of our own work around the edges where we see the long bond might have some time. We might do some trading in that, for
Yep,
example,
yep,
on a
yep,
on a
yep.
very customized basis.
Got it.
So, anyways, I don't know why I brought up the debt fund, but
Well, we were
yeah, we'll,
talking
we'll have
interest
another
rates
tool
and
there.
a
Yeah, but on
pivot
rates,
pip.
yeah. So
Yeah,
in the perfect world, I'd love to have a sort of a flat interest rate environment for the next several years. Then that would be easy to innovate around. And then for your business, it would be easy to work things around. But
exactly.
not knowing where rates are going to be 6 months from now is challenging for any
Pe-
business. So
People aren't moving, right?
yeah,
They're not doing anything.
yeah, exactly. So
So I
okay,
mean,
let's
and what that means for us in the fund is that we spend most of our time making sure that companies, with a few exceptions that are what you can really see that they're acquiring customers for less than what they're worth and the growth path is clear, for the most part we're saying, like, don't put yourself in a position where you have to raise money. So the focus has been on profitability. When you take growth out of the market, that leads to the overall climate of things not moving, right? But it's like it's what you have to do, right?
yeah, yeah. Well, let's keep going on this. Where are you seeing real opportunity now, not just hype, in areas like emerging technology, like artificial intelligence, blockchain, or even climate technology, with
Hmm.
the word climate being built into so
Yeah.
many things nowadays. Where are you
Well,
seeing real opportunity?
yeah, I would pick two from that list. I mean, we're well past hype on the AI continuum. I mean, it's this is real. I mean, initially, it's being used effectively to make operations more efficient and getting more done with less people. So that's been very helpful under the theme of pushing towards profitability that you and I discussed earlier. Pure AI plays, we haven't done a lot, but we're starting to look more and more at them. It's still early, but I think it's a market that is growing quicker than any other technology I've ever seen in my. It's a fact. I mean, it's growing quicker than any other technology in the history of technology. So the AI is well past the hype. We're excited about it. Um, you got to work hard to stay on top of it, and you got to work hard to not overpay, because at the beginning of every cycle or every trend, there is still hype in it, and people are willing to, they at the risk of not missing out on the next big thing. People are willing to pay a lot. We saw that in the public markets with Nvidia, uh, and the Chinese competitor came out with cheaper chips, and overnight it took X billion out of the market cap of that company. So, I mean, getting at the right level is still the name of the game of being a good investor. The other area that we are spending a lot of time on, and we've got I think 140 odd US in a fund focused solely on this space, is the blockchain and crypto technologies. My partner John in particular has always been a big fan of decentralized networks. Thinks the government has just got too many tentacles into us in terms of data, et cetera. And he thinks that this is going to be a massive change in the way that networks run, with less centralized control and less need for banks, and a lot quicker and more efficient ways to move money, for example. And on that fund, 40% of it is liquid, so we trade like you would any other stock. And a lot of our private investments are just like venture investments, where the core asset is the blockchain in this case, and we're running different ideas. We're backing different ideas using that technology. And ironically, a lot of these companies have tokens, which is their form of IPOs. So there's a market that they create by launching tokens that get traded, and that often provides us a return on our investment. And that fund has a little over doubled in 14-15 months. So we're very bullish and happy on that future. So those are the two areas where I spend the most time. We do have 3 climate oriented investments.
Okay.
And we did have a fund and a strategy around climate. But I really did find that if we wanted to stick to our made in Canada thesis, which we don't on the blockchain, by the way, it's just too young and you really have to go where the deals are. But we do have a global network there. But on the climate side, we really struggled to find deals that we could do at a reasonable valuation, because again, the hype around climate, there's the mandate that so many people had to invest in it at that time, led to inflated prices. Now, with the Trump effect, where he's stripping environmental protections away left, right, and center, it'll be interesting to see what happens over the next couple of years with investment valuations in the climate technology space. But our experience was it was tough to find deals at a reasonable price.
And with everything going on in Western Canada, with Canada's most valuable asset being energy, are you doing or finding anything in that space? Has anything opened up with that area?
Not for us. I think about when we were talking about climate, my head was at the back of my mind. Should we talk about carbon capture? As an example, right? Of how do you produce cleaner energy? And I know there's a lot of money going into figuring out how to capture carbon, stick it back underground. But we're not in the science project business. I mean, I know we're both fans of taking a long lens on things. But I can't afford to do that with my clients' money, let alone my own, when it's just that far out. So my only oil and gas interest is just like every other Canadian's, saying what the heck's taken us so long in getting our act together to not be at the mercy of the rest of the world by not having a way to ship this stuff to where it needs to go. While working on making it cleaner. The two aren't mutually exclusive, but I think we've shot ourselves in the foot the last decade under Trudeau, when none of this stuff happened, right? And it's interesting that debate, the last Canadian debate, I thought the point that Poilievre made, I wish he had a triple down on it, was like, when you look at climate, and Canada's contribution to the global problem, it's a pimple on a dinosaur's ass, right? When if we were shipping our relatively clean natural gas to India, allowing them to close X number of coal plants, that's how you really impact climate, right? But somehow that all gets lost in how unclean building a pipeline is, right? So, that's I'm more interested in it from a future of the country perspective, but from an investment perspective, I don't know how to play it.
Okay, let's finish up here. These are related questions. What are your thoughts on institutions selling positions at a discount due to liquidity concerns of late? And is now the time to be more opportune in looking at secondaries with all the forced selling?
I think so. I think the answer to that is yes. Um, you know, our business, our blockchain fund, for example, is a perpetual fund. Like, money comes and goes, and it could, if we wanted to, go on forever. A lot of the funds that are invested in technology companies, some of which that have done very well, have a shelf life to them. They need to return the capital to their investors, usually at the end of 10, maybe 12 years. So you do have a lot of selling now of secondaries as people have to raise money. And again, it's not sometimes just the fund life ending. It's people need the dough today. Like, it's a good time to be in cash. So there is pressure on liquidity, and I think this could be a very good time to be looking at secondaries that people are unloading for very valid reasons.
Okay, well, that's great, Bruce. I'm going to chat with you a little bit more once we stop recording here, but I do appreciate the insight, the updates, and the work your firm does for us, and just gives us another whole level of diversification. And it's things that the average investor couldn't really get their hands on.
I
There's no
appreciate and
ETFs out selling things like this, and as soon as there is, that's probably when you'll be getting a redemption order from us because we don't like
okay.
to follow the masses.
Well, we'll see. But listen, I'll take this opportunity to thank you guys for your support as well, because it's through firms like yours that we address the issue that we talked about off the hop, which is how do we continue to grow and maintain and keep the IP in the country. The way we do it is by getting behind some of the companies that are making Canada still one of the best places to make an investment on the planet.
Yeah, perfect. Well, thanks for everything. And Ken, maybe let us know when the recording stopped.
You're most